See, you all know that we have 35 accounting standards in FR, and what I consider Ind AS16 will have a very great impact in learning of other accounting standards. So the title for this being PPE. The title is PPE, Property, Plant and Equipment. So what are the things that we should basically understand in CA final level? A PPE is basically a non-monetary asset. Is basically a non-monetary asset. When we tell something about the asset, it should derive future economic benefits, FEB, and the cost can be measured reliably. Cost can be measured reliably. Then comes the future economic benefits should be minimum more than 1 year. Okay. So non-monetary assets where you say which is tangible in nature and it will derive future economic benefits. Future means it should be deriving benefits for more than one accounting period. There is no specification that they have conveyed that it should be having a minimum of 5 years or something like that. And the cost can be measured reliably. So when we take something about cost, cost is equal to the purchase cost. And it has got, it includes certain things and it excludes certain things. So what can be included, what can be excluded? So all expenses incurred till the asset is made available for its intended use will be included. So all those items which are not incurred to that level are to be excluded. So any site opening expenses, all that are to be excluded. So that comes as a matter of common sense only. And under inclusion, what I consider as very important, two things. Borrowing cost when Ind AS 23 conditions are satisfied, then borrowing cost can be capitalized. Then decommissioning cost are to be taken up. So the rest of the matter, what we have studied to be included and excluded, were all there from intermediate. So borrowing cost in intermediate also you are having, but what you never thought of could be decommissioning costs. So that means it is not what we have incurred alone, what we will be incurring in the disposal of the asset at the end of its life should also be captured, and depreciation has got to be charged on that. So if that be the case, what is the journal entry that we are expected to pass? So debit, PPE, credit, cash, credit, provision for dismantling. So imagine, for the sake of journalizing, let us assume that the payment what you make is 10,000. Cash includes bank also. The payment affected by check is also taken up as cash. So 10,000. Provision for dismantling, let us assume that it is 4,000 and our PPE will be taken up at 14,000. Please understand, this 4,000 is not the expenditure that will be incurring, say, after 5 years. It should be the present value of decommissioning cost. So we are not expected to take up absolute value into our books of accounts. So we are expected to take up the present value of decommissioning expenses. So now we need to understand what is the present value, and for that purpose, what is it we should take up. So what we normally take up in capital budgeting, the same principles only we are expected to take up. So present value of the future expenses is expected to be captured, and in the balance sheet, you would be finding on the asset side PPE at 14,000, and the provision has got to be taken up at 4,000. Correct? Under what head this PPE will be taken up? Non-monetary assets or non-current assets, you can say non-current assets or non-monetary assets, or you can say non-monetary. Okay. See, what do you mean by monetary, and what do you mean by monetary, and what do you mean by non-monetary? So if you know the meaning of monetary, then we can easily understand what is non-monetary. Can you tell, Anjana, as what do you understand from the term non-monetary?
Which does not involve money in it, something like that. It's which is not liquid.
How would you rate prepaid expenses? How would you rate inventory?
Um,
Inventory upon sale, it will become liquid, no?
yes.
What do you mean
You
by
asked
monetary? Can you give example for monetary items?
monetary items. Monetary items example. Cash, marketable bank deposits or debtors.
How about inventory?
Inventory is inventory held for sale. It is not a monetary item
Why?
because it cannot be it is not fixed, or like it's not currency based.
But inventory is expressed at monetary terms, no? Do you mean to say that so much of inventory in terms of kilograms and liters are to be reported? They're all expressed in financial terms only. You have an exclusive accounting standards for that. So, so firstly, we should know what is monetary. Then you can easily understand whether it is monetary or non-monetary. I will tell you this way.
Okay.
Those assets which are stated in the balance sheet, when they are expected to be realized at the same value at which they are stated, they are all monetary. What is that I stated? See, this is not a definition in any textbook, which I am telling you. Assets which are reported in the balance sheet, they are expected to be realized at the value at which they are stated. Theoretically speaking, cash, you are expected to have your bank balance converted into cash at the value at which it is stated. Debtors, the value at which they are stated, you are expected to realize. Are you understanding what I'm telling? Inventory, the value at which it is stated in the balance sheet is not the value at which you realize. Say yes or no.
Yes, sir.
That's it. So inventory, even though it is a current asset, but it is not monetary. If you look into our institute presentation, in current asset, they say monetary assets. They include cash, debtors, and inventory. Even though it is a current asset, they include this as non-monetary. Are you understanding? So likewise, the plant and machinery value at which it is reported is not the amount that you realize upon sale. Even though I don't have the intention to sell, that value at which it will not be realized. Inventory, even if I have the intention to sell, the value at which I realize inventory will be different from that of the value at which it is stated. So therefore, it is not monetary. So The debtors which I reported in the balance sheet, theoretically speaking, that much money I should realize. You might even argue that you can have bad debts, provision for bad and doubtful debts. Say those are all extreme cases. The value at which they are reported in the balance sheet or the values at which you realize those items are monetary. Simple as that. Is that clear? Now, provision for dismantling is 4,000 and we have whether the provision will be reported as current liability or non-current liability. Whether it will be reported at current liability or non-current liability. Come on.
Depends upon the life of the asset.
Depending upon the life of the asset.
When the asset should be decommissioned or dismantled.
When would mean, you know, at the initial stage of buying itself as when it will be taken up. So that will be taken up as long-term provision. Is that right? Now,
Yes.
imagine that this 4,000 is expected to be in 5 years period, 7,000 rupees. Correct? Imagine that you would have 10% discount that you have made and that is brought to 4,000. See, I'm not just there to commit at 7,000. Let me use my calculator. Let us assume for the sake of simplicity, 4 years later, it is 5856. 4 years later, 5856 is today, it is at 4,000. Now, what we are expected to take up for the purpose of depreciation is 14,000. Right? And imagine a straight line method is adopted. 14,000 for a period of 4 years, I got to take up would mean. So it will be split into 4 installments, 3,500 in each one of those cases. And the light put. Is that clear? So 3,500 will be the depreciation, but this 4,000 will not be there at 4,000. And let us just understand how it travels. So first year in, second year in, third year in, and fourth year in. So this is at 4,000. This I should get 5856. So what should I do in year number one? 10% PV factor, and this will become 4,400. So 440, and it will become 4,840. 484 it will become, and 4,840 into 1.1, that you get as 5,324. So 5,324 minus 5,856, you get 532, and that's the way your liability will become 5,856. Is that clear? So what is this 400, 440, 484, and 532 that we are expected to do? We call them as unwinding of discount. So what we are expected to do is, this is the finance charge that we are going to make, and you will be having depreciation of 3,500 reported in each one of those years. And they might ask you the question in this fashion: the cash cost of the asset is 40,000, and present value of future dismantling decommissioning is 4,000, and 10% is the PV factor. And they might ask you a question: what is the sum that you will be debiting to profit and loss account in year 3? So they might say A, 3,500. B, they might say as um, hmm, they might say this as 3,000. C, they might tell as 3,984, and D, they might report as 4,840, something like that. So you need to know as how much is the total transfer to profit and loss account in year number 3. So unwinding of discount You got to debit to P&L account and credit to the liability. And this depreciation also you should take up. So answer to that question should be 3984. So what students might think that debit to profit and loss account is only a depreciation, they might select 3500. So how it works, now let me just show you. So in your uh, liability account, year number 1, 2, 3, and 4, you have opening balance of 4,000 and you have unwinding of discounts or finance cost of 400 and your closing balance will be 4,400. See, whatever I've just shown here, it will be taken up in the form of a table, and 440, it is 4840, 4840 and 484 and 5324 and 5324 and 532 should bring you 5856. This is the balance that you will be ending up with. By the same point of time, your WDV of the asset will be brought to how much? Your WDV for the first installment of 14,000 will be brought to 10,500, 7,000, 3,500, and this will be brought to 0. So you can just make note as what is the depreciation as 3,500 in each one of those years. So the sum of the debit that you're going to take up will be 400 and 3,500, 440 and 3,500, 484 and 3,500, 532 and 3,500. Is that clear? So you need to be very careful. So don't jump into conclusion that it is only depreciation that you keep it into profit and loss account. Even unwinding of discount, the finance cost also you are expected to take up. Is that clear? So at the end of the 4th year, you will not have any asset, but you will have a liability to the extent of 5856. And this you may have to pay it off by debiting. There is decommissioning provision for 5856 and credit will be given to cash for 5856. So thereby your decommission and the amount is settled. Is that clear? And that's the way we are expected to take up the entire accounting. Is that okay? Are you clear?
Sir, just a small doubt.
Yeah.
Sir, in the amortization table which you drew now, the 10,500 எப்படி வந்தது?
So
Closing
10,500 is 14,000 minus 3,500 first year. Second year, 10,500 minus
Oh,
3,500.
that is without taking the finance component. Finance component goes to
Yeah,
provision.
yeah, this is the asset.
WDV. Okay, okay,
Oh.
okay.
So this is for the loan component provision.
Okay, sir.
Are you understanding? So you need to know about decommissioning. This decommissioning expenses can go up or it can come down based on the estimates that are going up or coming down. And when they are going up, then what is it we should do? We should add it to the cost of the asset. And for the remaining period, you got to amortize with the increased cost. And you cannot be doing it on a retrospective basis. Say, imagine at the end of the first year, the initial judgment of making it as 5856. So people might have revised it to say 6,500. So that means to reach 6,500, how much provision you got to make for the remaining period. Are you understanding what I'm telling?
Yes, sir.
So now let us just take up that sort of problem also. So at the end of year number 1, they have estimated year number 4 figure should be 6,500 instead of 5856. What is it then we should do? At year number 1, they have come to a conclusion that 5856 is not correct. So by year 0, you have estimated the decommissioning cost at 5856. Now at the end of year number 2, you are expected to review the salvage value, the remaining useful life. And in this case, residual value is not there. You got to dispose it off. So your decommissioning cost had swelled and the estimation what you have made was not correct. And when it is coming to 6,500, what is it you should do? So here is a place where you have the catch. You got to be good in capital budgeting also. So now you are at year number 1, year number 2, year number 3, and year number 4. You were at year number 0 when it was 4,000 that you taken up, and you made 400, and it was 4,400. Am I right? Now the figure of 5,856 is getting revised to 6,500. What should you do? Here is a place where you have the catch. So now you are at year number 1, 4,400. You are at year number 4, from 5,856. You are revising it to 6,500. No big deal. Don't panic. It's very simple only. What is it you should do? This is the future value. This is the present value. How many years that you have? 3 years you have. So you all know future value is equal to present value into 1 plus r to the power n. So this is going to be 6,500. Present value I do not know, but I know everything else. 0.10 to the power 3. So then what is that I should do? 6,500 multiplied by 1 divided by 1.1 to the power 3 is equal to present value. So now 1 divided by 1.1, 1, 2, 3. So you just get third year PV factor 6,500 into 0.7513, which is equal to the present value. So 6,500 into 0.7513, it should be 4,883. That means it is not 4,400 anymore. It is going to be 4,883. So your provision account is going up by 483 rupees. Am I right? What is the journal entry that you would be passing? Debit PPE 483. How did you get 483? 4,883 minus 4,400. You get 483. Am I right? And your provision account has got to be increased by 483. So it will not be 4,400. It is going to be 4,883. Is that clear, all of you?
Yes, sir.
See, don't get panic and all that. Same capital budgeting exercise only. So what I will do is that the problem that was originally planned, now that you have a revision, then what is it we are expected to do? Say now, let us just take up that. So year number 1, 2, 3, and 4. And you have opening provision of 4,000. You have a finance cost to the extent of 400, and you have a closing balance of 4,400, and 4,400 on which I am adding 483. So 4,883 it is becoming. Am I right? So
Yes.
10% on that is equal to 488. Am I right? So now let us just take the calculator and take up 4,883 plus 488. That should give you 5,371. So 5,371, and next 537 you will be taking up. So plus 537 when you book, it comes to 5,908. And your target is 6,500, which is known to you, and it is 5,908. So to which, so you have to take a 591. So now let us just put that. See, there will be a small approximation error, which is a possibility, plus 591 when you put, which comes to 490, 6,499 it will come. So instead you make it as 592. Is that clear, all of you? So
Yes.
don't panic. Please understand. This is going to be a possible question, and so we would have just done problems involving decommissioning generally, but we would not have taken up the session with a change in the dismantling or decommissioning expenses. So what will happen for your, this is for liability side. For the asset side, what will happen is that you will have opening WDV, and you have depreciation, you have closing WDV, and it was 14,000 originally, 3,500 you deduct, 10,500 you make, and 10,500 you have. By this point of time, 483 you got to add. So 10,983, it will not be 3,500, my dear. 3,500 was correct, provided you had the same figure of 14,000 there. So now, what is it then you should do? So 10,983 shall be divided by 3. So it is 3,661. 3,661. So that has got to be deducted from 10,983. The figure is 7,322. So 7,322 and 3,661, 3,661. Then 3,661 and 3,661, and it is going to be 0. Is that clear? So they might ask you a question by asking a question, what is the sum to be transferred to P&L account in year 2? This is the way they just normally do. See, let me tell you, if you panic, easiest thing also we will not be in a position to do. I'll tell you a classic case. When we are panicking, our breathing will not be within our control. So we will just have a short breath and we will not be in a position to think properly. So what you people need to do under examination condition when you are coming out with a new scenario, have a long breath. This is what you need to have through pranayama. So you don't put this way and do. So don't panic. Don't panic. See, I used to see as how lion will hunt. There is going to be one hunter which will be going, and the remaining will be just watching. And once the prey is put down, you don't find that they rush. They'll go slowly and set things, and then they will do. Whereas wild dogs will not be doing like that. So within 5 minutes, the prey will be completed. That is the pack of wild dogs will do. Whereas the king of the jungle will keep cool, even though it will show its, but it'll act cool. So the pack of lines you always remember, that is Lord Lakshmi Narasimha. You just think of, you will never be panicking. Panicking is the worst enemy for CA students. Don't do that. And think of Lord Lakshmi Narasimha and you will just get it. So now, what is that you find that you're going to do? 488 and 3,661 and 488 plus 3,661. That should give you their debit to P&L account as 4,149. Is that okay? Are you clear?
Yes, sir. Yes, sir.
See, but the way in which you are saying yes, sir, I find that you are scared.
No, I was just calculating. I was noting down.
Are
I
you
was
clear
doing
now?
this problem.
Yeah,
Yes,
no
yes.
problem. See, the same thing will be applicable when the revision is resulting in reduction in the dismantling expenses, say from 5,859. If it were to be 5,000, then what is it you should do? So whatever plus we have made, we have got to deduct. Are you clear?
Yes.
So now let us just try that. What is it we should do? See now, this is variant 2. Variant 1 we have done. Variant 2, I will put it like this way. So year number 0, year number 1, year number 2, year number 3, and year number 4. So it was 4,000. You had 5,859. 400 gone, and it was 4,400. Then by that point of time, they have made it as 5,000 only. When it is 5,000, then what is it you should do? So from here to here, what is the distance that you have? 3 years distance only. Year number 1, year number 2, and year number 3. So 3 years, don't look into the number of lines that you have. So that may mislead you. So you start counting this as 1, 2, 3, and 4. No, it's not like that. So the period only you should take up, not the points there. So therefore, the amount is going to be 5,000 multiplied by 0.7513. So once you know the template, no, it becomes very easy. That's the reason as why I'm telling you, you need to practice a lot into 0.7513. That should give you 3757. So from 4,400, you got to make it out as 3757. So what is the reduction that you are expected to make? 4,400, when you just do, it is 643, you got to reduce. 643, you got to reduce. And because of that, this is going to be 376, 3757 plus 376. So that will be 4133, and 413 you take up. 4133 plus 413, then you take up. It is 4546, and it should make up for 5000, would mean 454. When you do that, it will come to 5,000. So what will happen to your the asset value? So asset value, it was 14,000, and you have made 3,500, and you got 10,500. On 10,500, what is the reduction that you're going to make? 643 reduction you're going to make. So 10,500 minus 643 when you make, that comes to 9857, and 9857 should be divided by 3, and what you have to take up as amortization for the next year is 3286. So 9857 minus 3286, that should give you 6571. So 6571, 3286, when you do that, minus 3286, you just end up with 3285. So 3285, 3285, and you make it out as 0. So therefore, dismantling cost, on which unwinding of discount is nothing but taking up to the future with borrowing cost. So don't get the impression that I got to book my interest only when I borrow. Even when I incur a liability, even when I am assuming a responsibility, that I got to pay so much, and I cannot be taking up at the absolute values. So where you are just doing it at present value, and to take it to a future value, you got to book your cost there, the finance cost. So don't get the impression that borrowing cost is only for the money that you borrow. For the responsibility that you are having it 4 years hence, you have to take it at spot, at the present value, and then you are expected to do. So therefore, what is very important is, therefore, what is very important is the amount of present value that you should take up. So not the absolute values. So the present value techniques and unwinding were all considered to be very normal. So whenever there is any change in the decommissioning cost, you have to take suitable action, whether you got to add or deduct on either side of the balance sheet. And for the remaining term only, you got to make those changes. Is that clear?
Yes, sir, clear.
Clear. Okay. See now, what I would like to do at this moment, I'm going to give you. Hmm? No, he has not come. So what I would like to do is I would like to give you a problem. So that problem, I would like to share it through your WhatsApp. So let me take up. So please just confirm that you are just getting it. Hmm? Huh?
I didn't get it.
No, you are getting it now.
Okay.
This is only the single page that you have, and you will just get it.
Yes.
You got it?
Yes, I got it.
Yeah. So I would like to send that to Rajagopalan also. One moment, I will send to Rajagopalan also. So let us just try that. So now, shall we start solving the problem? I will share the screen and let us just find out as how we can take it up.
Yes, sir.
Rajagopalan is also sent with that. Say now, let me share the screen. The screen is looking like this way. Please just confirm that you are seeing the screen. So let us just take up this. Flying Airways Limited is a company which manufactures aircraft parts and engines and sells them to large multinational companies like Boeing and Airbus Industries. On 1st of April, the company began the construction of a new production line in its aircraft parts uh, manufacturing shed. Costs relating to the production line are cost of basic material list price 12.5 million less 20% trade discount, recoverable goods and services tax incurred not included in the purchase cost 1,000, employment cost of the construction staff for the 3 years to 30th of June 20x1 1200 and other overheads directly related to the construction 900, payment to external advisors relating to the construction 500, expected dismantling and restoration cost 2000. Additional information, the construction staff. So let me just make it a little bigger. The construction staff was engaged in the production line, which took 2 months to make ready for use and was brought into use on 31st of May 20x1. Other overheads were incurred in 2 months period ended 31st of March X1. They included an abnormal cost of 3 lakhs caused by a major electrical fault. The production line is expected to have a useful economic life of 8 years. At that at the end of that time, Flying Airways is legally required to dismantle the plant in a specified manner and restore its location to an acceptable standard. The amount of 2 million mentioned above is the amount expected to be incurred at the end of the useful life of the production line. The approximate discount rate is 5%. The present value of rupee 1 payable in 8 years at 5% approximately is 68 paisa. 4 years after being brought into use, the production line will require a major overhaul to ensure that it generates economic benefits for the second half of its useful life. And the estimated cost of the overhaul at current price is 3 million. The company computes its depreciation charge on monthly basis. No impairment of the asset has incurred on 31st of March X2 required or requirement. Analyze the accounting implication of costs related to the production line to be recognized in the balance sheet in the statement of profit and loss account for the year ended 31st of March X2. So I would provide you 5 minutes time to go through before I take up the matter for discussion. So please just go through that. I will just join in a minute. Now, let us just take up one by one. Are you clear? Have you just gone through this input adequately?
Yes. Yes.
What is the date on which they started constructing the new production line?
1st April
First,
2001.
right. 2001, 1st of April. What is the date on which they want you to have fully done for the year ended 31st of March X2? It is a self-constructed asset. Is that right?
Yeah, they're constructing it.
Okay. Say, is it PPD or PPE or is it inventory?
PP.
Okay. How do you say it is not an inventory? Because I find by reading the first paragraph, they say it's a company which manufactures aircraft parts and engine and sells them to large multinational companies like Boeing and Airbus industry. So is it not giving you an impression that it is a inventory?
It is now for these details are given for a new plant which they are doing in their manufacturing shed.
Correct. So began the construction of new product line in its aircraft parts of manufacturing shed. So therefore, a possible confusion might be there as whether it is inventory or PPE. It is PPE only. Production line is nothing but a factory or something like that. So cost of basic material list price 12.5 million less 20% trade discount. So what whether is it appropriate on the part of the company to deduct 20% trade discount or
Y-
only cash discount has got to be deducted, trade discount should not be deducted, anything like that? Is that
Trade
right?
discount can be deducted.
Trade discount has got to be deducted. Cash discount should not be deducted. So therefore, the figure of 10,000 that they are given is correct. Then recoverable goods and service taxes incurred not included in the purchase cost. What do you mean by this? Recoverable goods and service taxes incurred and not. Eh, Rajagulam, Swami. So incurred not included in the purchase cost. What is it we are expected to do in this particular case? What is this? What is
ITC.
this?
Don't take
Varsul. Huh?
ITC.
ITC. So whether these figures were included in the above or not included in the above?
Not included. It should not be included.
Not included, and the correct treatment is not to be included, which is correct. So therefore, what you people need to do as a presentation is that you write that and put a dash, and you have one more column for remark. So what you are expected to make a presentation? How do you make a presentation? Your presentation has got to be made like this way. So serial number, items, then cost in rupees in thousands, then remarks. So you can't just do remarks separately. We might forget. So number one, the presentation is so important. The cost of basic raw material, I will put it out as raw material. So I will put it out as 10,000. So trade discount is to be deducted. Is trade discount deducted is correct. Trade discount deducted is correct treatment. Then number two, uh, input uh, input tax credit dash nil. So it should not be considered. Input tax credit availed cannot be capitalized. Correct?
Yes.
You cannot capitalize as well as take credit. You cannot do both. And that is applicable even in the case of GST. So employment costs of the construction staff for 3 months up to 30th of June, X1 1200. So here they have mentioned construction staff was engaged in the production line, which took 2 months to make ready for use and was brought into use on 31st of July, X1. What is this? Are they contradicting each other or complementing each other?
Um,
See, I will put it like this way. the given information in the table, cost of the basic material, list price of 12.5 less 20% discount, they are complementary to each other. They never contradicted. Same is the case, recoverable goods and services, they support you and you have just done. So is there any dispute in taking up 1200 directly, or is there anything that
Yes.
we have got to reduce? So offer your comments. Come on.
1,200 is for 3 months, but a
Mm.
construction period is only 2 months. So only 2 months is to be capitalized.
So what is the date on which it was put to use? So putting to use was, mm, what is the date? Where is that they mentioned?
31st May.
Uh, it was brought to use on 31st of May. But they have taken up for how many months? They have taken up
30th June.
for up to 30th of June. So 1200, you have got to make it out only for 800, correct?
Yes.
So you got to make it out as 800. 1200 into 2 by 3 shall be taken up. So you offer explanation like that. And then other overheads directly related to the construction is 900. Is there anything that you got to go through in the second bullet point on this? Other overheads incurred in the 2 months period ended 31st of May, April, May. They included an abnormal cost of 3 lakhs caused by major electrical fault. So why would an abnormal cost be included there? So therefore, you got to exclude 3 lakhs in that. So they have put 900. So you got to put 900 minus 300. Only 600 has got to be taken up. Is that right?
Yes.
Then um, then what is that? You have payments to external advisors relating to the construction. Yes, it has got to be taken. So, which is a professional cost that you have incurred exclusively for the purpose of doing this thing, construction, and no portion can be deducted. The entire 500 has got to be taken up. So, external 500 you got to take up. So, you got to write something like that. Then expected dismantling and restoration cost. So at the end of the time, useful life 8 years, and legally required to dismantle the plant in a specified manner and restore its location to an acceptable standards. The amount of 2 million mentioned is expected to be incurred at the end of the useful life. So therefore, what we have expected initially that it could be a present value is not present value. It is only what? It is future value. So now you're expected to take up at the present value, and the present value is 68 paisa for 8 years for at the rate of 5%. So how much is that present value that you should take up?
1,360.
1360. Is that right? So okay. And approximate discount rate 4 years after being brought into use. The production line will require a major overhaul to ensure that it generates economic benefits for the second half of its useful life. So what is it we should do? Such an estimated cost of the overhaul at the current price is 3 million. So at this moment, shall we just close it up by totaling it up? How much is the total that it comes to? That being
13,260.
10,000 plus 800 plus 600 plus 500 plus 1360. That comes to 13,260. Is that right?
Yes.
So here is a place where you have something called as component accounting. What do you mean by component accounting? So I consider that to the extent of 3 million. 3 million means 30 lakhs. 30 lakhs in terms of 1,000, it is 3,000. So I deduct towards a particular portion which will last only for 4 years. So that portion we are expected to take up, and depreciation has got to be taken on a monthly basis. And what is that we should do? Is this um, item to be replaced in 4 years period being 3,000. So that means 10,260 will live for 8 years.
Mm.
Say yes or no?
Yes, sir.
Right. So monthly depreciation charge you got to make, no impairment you got to take up. So now, having done this, the question what they have given in the paper is analyze the accounting implication of costs relating to production line to be recognized in the balance sheet statement of P&L account for the year ended. So then what is it we are expected to do? Come on. So that means the figure of 13,260 will be split into two as 10,260 and 3,000. Am I right? So this
Yes.
is the cost breakdown. So what is the life that you have in this case? 8 years, and in this case,
4
4 years.
years.
What is the depreciation per annum? That is for 12 months. So 10,260 divided by 8. So 1282.5 and 3,000 divided by 4, that comes to 750. So depreciation per month, here it is 62.5 and 1282.5 divided by 10. Sorry, divided by 12. So it is 106.875. So number of months that you got to take up, 10, correct? 10 months, 31st of May itself, it is ready.
Mm.
So here there is no borrowing cost that you take into account. Is that right? So now
Yes.
depreciation for 10 months, what is that you will take up? So 1068.75. And here it is going to be 625. So plus 625 when you take up, it comes to 1693.75. Are you understanding? So in your balance sheet, as production line, 13,260, from which your depreciation of 1693.75 has got to be taken up. And 11,566.25 has got to be taken up. And here, for production line only, they have asked, not for the liability, but we can just do that. No big deal as far as the provision is concerned. Provision is 1360, and we are expected to take up provision for 10 months. So how much is that? 1360 into 0.05, 68 divided by 12 multiplied by 10. By doing that, it comes to 57, and we are expected to take up 1417 in profit and loss account. How much is that we will take up to depreciation? We will take up 1693.75 to finance cost 57. I got to take up. Is that clear? So these are the points that normally students miss.
Sir, why 57?
So 57 is for interest cost. So why it is interest cost? 1360 multiplied by 5% for 1 year. But in
Wait,
this period, you have only for 12
only
months.
10 months. Okay.
Sorry, 10 months. Is that clear? So the way
Yes,
in
yes.
which you are questioning itself, where you did not catch that point.
No, I only took 5%. I didn't take 10 months.
Yeah. So that means 5% is for fully 12 months period. When the asset itself is ready only at the end of 31st of May, how can you create interest cost for the entire 12 months period? So
Yes, yes.
that's the way you got to do. Say, therefore, the consciousness that we were having as what you got to compute for capitalization and how much depreciation has got to be taken up by applying component accounting and how much is the finance cost that we are going to take up. See, all that, what is that we are doing? All that we are prompting ourselves and mark it out as very important for your examination. So whatever we have discussed today, so we have discussed about what and all we have got to capitalize. When there is a change in the decommissioning by increase or by decrease, we have got to make those. I have not complicated this by adding one more item. What is that? So the useful life is extended by 2 more years. So that point of time, then you got to take once again a future value for a new period, and you got to make changes to the liability, and the liability might go up or come down, and the same treatment has got to be extended. And please be careful, depreciation is not for the remaining useful life, and when it is elongated by 2 years, you should count that also for calculating depreciation. Is that clear?
Yes, sir.
Okay. So today I